Welcome to the Brokers Lounge with Eddie and Carlo.
Well, welcome back to the Brokers Lounge. My name's Carlo and I'm joined by my illustrious colleague, Eddie. And today we're going to talk something about with regards to one of the bigger decisions that people face when it comes to purchasing a property. And that's whether they buy off the plan or whether they buy an established property. So, but before we jump into it, how are you, mate?
I'm very good, mate. I'm very good. How you doing?
Doing all right.
Doing all right?
Yes, yeah. Yes. Sorry, should I have given you a drum roll? You
No,
give me a drum roll.
That's all right.
You don't want a drum roll?
I'll manage.
And the week's been good?
Yeah, been busy.
Yeah.
We're seeing a lot of potential movements in the market, so a lot of questions coming through and a lot of people trying to get on the front foot. So, yeah, it's interesting times.
It well and truly is, and it's probably one of those times where there's a lot of outside global forces that are changing our market here in Australia. So, which is, we probably haven't seen that since COVID and before that the GFC. So, it'll be interesting to see how everything plays out and whether our lovely little friend at the RBA decides to give us a bit of a reprieve and cut rates again. But anyway, that's another story for another day. So
it looks like it's coming. So we'll see in May what the meeting will come to.
Yeah, very good. Before I jump into it, I'll probably just give everyone just a very quick, brief understanding in terms of, I guess, the definitions when we talk about off the plan versus a completed property. Obviously, a completed property pretty much says how it is, really. It's something that's ready to occupy straight away. But off the plan is simply when you're buying a property that's, in most cases, its construction's already commenced.
Yep.
However, it's not finished yet, so you're buying it well ahead of schedule. They may be just pouring the slab or something like that, but it's normally part of a bigger development as such. So, but I think maybe to kick off with Eddie, maybe if we can just talk about off the plan purchases, and if you can maybe just run through some of the pros or the advantages of buying off the plan.
Yeah, absolutely. So one of the advantages of buying off the plan property is really time. Okay, It gives you time to save more or plan accordingly, because off the plan would give you roughly like 18 months to 2 years, 3 years to plan. Obviously, that comes with the risks, which we'll talk about later. But that's one of the advantages is getting in. You don't need to pay anything until the property titles and then the construction starts. So it's given you that buffer in terms of planning, saving, and getting ready for it. It comes with a lower upfront costs, like stamp duties. So most probably you'd be paying stamp duty only on the land portion of the build, or in case it's a high-rise apartment, you might not be paying much. That saving can help a lot of people get into the property market and save a big chunk on stamp duties. This one is a double-edged sword, the potential capital growth before settlement. So in certain markets, like, you can't predict how the market's going to be once the property is completed in a couple of years. If you're lucky enough to be in an upward trajectory market, then you'll make gains straight away on the property by the time it settles. But the problem is, if you're in a downward trajectory market, then this can be a big problem, because obviously you'll be losing and then valuation will not stack up, and then you have to come up with all the extra costs. Obviously, moving into a brand new building, also a double-edged sword, because it can be really, just, you don't need to worry about anything. Everything's new. You're not going to have any issues or maintenance, hopefully. But also in certain instances, we've seen some shocking finishes where people move into brand new properties, but they've got a ton of problems that they need to deal with.
Yeah, it's probably one of those cases where once the builder's finished, they sort of they walk away and they go, that's someone else's problem now. Even though there is the builder's warranty that is always there, but then
we've seen instances where builders just go bankrupt, and good luck chasing them.
Exactly.
That is another one. And then obviously sometimes developers do give incentives for people to buy off the plan properties. So you could benefit from some incentives on offer. But I always say be careful, because you're paying for those incentives somewhere else. So it can be
one of those things that if it sounds too good to be true, it probably is, isn't it?
Yeah. So probably that in a nutshell, the advantage is like lower upfront costs in terms of stamp duties and other fees that you have to pay on a fully developed property, time to save more for settlement, potential capital growth by settlement time, new building that means less maintenance cost involved, and the incentives that can be on offer. But like we said, there's the cons, which I think Carlo.
Yeah, I'll run through in a minute. Just a quick question regarding lower upfront costs. Typically, what do people end up having to pay from a deposit point of view? Are they having to pay the full 10% deposit upon signing, or is it a lower amount that they typically have to pay?
So it depends. So a lot of off-the-plan properties, they're not titled yet.
Yeah.
Okay, so you pay a deposit which is agreed by the developer or the agent at the time. It could be $1,000, could be $5,000, could be $10,000, and that basically booking you.
So it guarantees you
exactly a spot. Yeah. And then when the property titles, then you have to do, based on the arrangement, a 5% deposit or the rest of the funds, so they can start with the construction. And obviously, it's different between like a high-rise apartment building or just an off-the-plan townhouse or a house. So it comes down to the agreement you have with the agent or the developer at the time.
Yep. Very good. Thank you.
No problem.
So I guess some of the considerations you need to take into account when it comes to buying off the plan, and it's probably going to be the exact flip of what Eddie's just gone through. But the first one would obviously be the market value. It can actually drop before you get to actually settlement. So yes, it works well in a nice rising housing environment or housing market, but if the market takes a downturn, what you're paying today may not necessarily be what it's worth when it comes to the settlement. And the issue with that is that the banks will, before they issue their final approval, which is going to be close to the settlement date, will do a valuation of the property. Now, if you've signed a contract for, say, $500,000 and then come close to the settlement when it's finished and the market's taken a dip and it's only worth, say, $450,000, the bank will only lend you against that particular value, not your purchase price. So the banks will always go with the lower of the valuation or the purchase price. So, and when it's off the plan, it's always going to be a valuation involved. It's not going to be, we'll rest on the contract price or we'll just do a drive-by. No, it's going to be a full valuation.
Yes.
So one thing to take into consideration, because it can work against you, that's for sure. So, and off the back of that is obviously the finance approval. It's not going to happen until right at the very end. So yes, you can get a pre-approval now, but a lot of things can change. So like you said, the timeframes can be 18 months, 24 months.
I've seen 4 years.
Yeah, so what's a bank is comfortable with today may not necessarily be what they're comfortable with in 2 years' time. So you have to be really mindful of that. Eddie just alluded to it now. Construction delays is a really big one, and I think we see it more and more nowadays. I've had lots of clients where they're, even with some of the smaller constructions, they're just going, the builder's just gone way over time, and the longer things go, the higher the risk can be with other things going wrong, be it valuations to you name it. So, and Eddie also talked about, a brand new build gives you nice new fixtures and fittings and all that. That can also be a risk as well, because the changes in quality or design between when you're signing a contract to when it actually gets completed can be completely different 100%. As well. So, another thing to keep in mind, and obviously the big one, which we see too many times nowadays, is if you run the risk of a developer potentially getting into financial trouble and maybe not being able to finish a project, or and then might mean another developer then comes in to take it over. Who knows? It'll be a whole range of different things. But it's really important to keep all these things in mind, because the upside looks great, but the downside, if it actually plays out,
can be horrible.
Absolutely horrible, yeah. And you don't want to do it. And like we said, buying off the plan in a rising market, fantastic. We used to see in the old days where a lot of people would buy off the plan. By the time it got to actually settle, they do a valuation and it's gone up in price. And some people would actually sell their property before it is ready to settle. 100%. So literally don't really outlay much and then offload it before it even settles. So
100%.
We probably don't see it as much nowadays, because I don't think the property market rises that quickly. And there's still a lot more people pushing towards having a piece of land as such, rather than an off the plan, development as such. So.
Yeah, absolutely. And probably one thing to add here is like if your financial circumstances change by settlement, you know, like when you first put an offer on a off the plan apartment, no worries, you're working fine, you're earning good income, you can service the debt. But then 2 years down the line, if your financial circumstances change, you lose your job, your income is not enough, servicing changes, policy changes, then you can be in trouble. So there's a lot of risk involved in it. So you have to be very careful.
At the end of the day, you are signing a contract with the developer. So, and that's a binding contract that they can enforce. So
100%.
And unfortunately, they're probably not going to care too much if you've lost your job or anything like that. They'll be saying, well, you signed the contract and
you lose your deposit.
Or you have to try and on-site with somebody else and run that risk that you're not going to maybe find someone. So
100%, yes.
Maybe we'll just go into the completed properties or the pros and cons of buying an established or completed property.
Yeah. The advantage obviously is you know what you're buying, you know what you're getting yourself into. You can actually inspect the property. You can see all the, if there's any issues with it or there's any really potential that you can do to the property. So it's there, you can buy it straight away. The property is ready to move into straight away, or you can rent it straight away. Your circumstances are not going to change in a relatively much shorter period of time. You're looking 3 months to 6 months to move into a ready property rather than
18 or 24 months.
It's easier for banks to value because it's available. So financing can be more predictable. You're not going to be surprised. There's comparable sales in the vicinity of that property. So you know exactly what you're paying for and what you're getting rather than high-rise or new developments. Like sometimes there isn't as many comparable sales, so you don't know. Like what's a?
I think that's a big one. I reckon that a lot of people don't really look into that much. It's like you might think you're actually paying a really good price, but if it's a new development that's going up and there's nothing that's been done in that area before, or it's a growing suburb or whatever it might be, how do you actually compare whether that's actually fair market or not? At least with an established property, you've got like-for-like sales. There's so much data that's available, and you can sort of like draw a comparison and say, well, that seems like fair value. It's a lot harder to do when you're buying.
It is, especially when like new developments happen in new suburbs. So as the city grows, councils start giving more approvals for high-rise apartments or new developments in new suburbs, which you don't have those type of buildings before. So it makes it even harder to understand what is the actual value of a 2-bedroom apartment in a 10K suburb from the city. Like if you go to the city, you'd have so many comparables, or closer to the city, you'd have so many comparables. But as the city grows, like we've got here, like Doncaster, 10 years ago, you started having all these apartments. So now you've got comparables, but now you've got new areas around the Doncaster or even further that you've got high-rise apartments, and they're relatively new. So it can be a bit of a hassle, and you just got to, do your research, do your due diligence, and ultimately do what you're comfortable in doing. Don't stretch it. So, I think these are the main, pros of buying a completed property compared to off the plan. Yeah,
and I guess when you're buying a completed property, like I said, it's there, it's ready to go. So for those people who are wanting to buy a home to move into, or even an investor that wants to rent it out, at least if it's there, you can go, right, I know if I secure it, I'm going to be able to do something with it straight away, rather than, I've secured this, but I don't know how, I'm not going to be able to do anything with this for another couple of years. So those who are very time conscious, and we come across that a lot, people are ready to, when they're ready to jump in the market, they're ready. They're not, I'm ready, but I'm happy to wait 2 years. So it's I think only for a certain type of buyer out there.
100%. And I think the biggest issue is you don't know the time frame. It's not specific. It could take 12 months, but it could take 4 years. And it's just that, lack of clarity in terms of when it's going to happen. It's just it doesn't sit very well with me. But
I'm the same, Eddie. It's not something that I would entertain. Yeah, there are some good upsides to it, but in my opinion, I think there's probably more downsides to buying off the plan because of the unknown. I'm not a type of person who likes the unknown, so I want to know exactly what I'm up for. So.
Yeah, and like another point to add here, maybe like if you're an investor, like you want to invest in off the plan property,
Yep.
and you go and sign that contract, so you're pretty much locked in.
Yep.
Okay, hopefully the property is going to be available in a year, but then if it stretches for 3 years, you're missing on other opportunities where if you had purchased an established property, you would have benefited from the gains you would have made over those 3 years, but now you can't do anything because you don't want to miss on finance and settlement.
So there's a real opportunity cost in that you're missing out on.
Exactly.
And like, not just the gains, but potential if there's tax benefits as well along the way. That's 2 or 3 years of missed tax gains. So big ones. Some considerations with regards to buying an established property.
Yep.
Probably the big ones, obviously, there's no stamp duty discounts in most cases. Obviously, unless if you're a first-time buyer and it's within the price range, then you can get some discounts there. But typically for the everyday person who's just buying property or investment property, there aren't going to be any stamp duty savings as such. Not being a brand new property, you could be looking at potential renovations or upgrades, which would mean obviously greater capital outlay. So yeah, it's nice to have a brand new property because you don't have to worry about things like that. And
I guess with this point, it depends how you look at it. It could be a pro, like if it needs some renos or upgrades.
Yeah, well, a lot of people look at it, and there's a lot of people there who do those property flips. So they go in there and they're actually looking for properties that they can actually renovate and upgrade because they know that down the track they'll be able to sell it and make a hell of a lot more money that way. So
100%. And I guess if you speak to a valuer, like I once spoke to a valuer where she was talking about certain aspects in a property that people think they give the property that nice look, but they actually add no value.
Yep.
But you're paying a premium for them. Like if you're having your, window showers, like the glass showers or certain aspects where people think these aren't nice and they must add value, but they cost a lot more and they add no value to the property.
Yep.
So if you're buying a property that's brand new, it looks very nice, you might be paying a premium for things that you could have done yourself for a lot cheaper and better way.
Yeah, and I guess if you're either a good handyman or you know people in the trades, then why would you leave it to a builder or a developer to build you something brand new and put their margin on top of that? And everyone seems to be putting margin upon margin upon margin. So it can definitely work in your favour that way. Another consideration when you're buying established property is obviously there's a greater upfront cash flow burden on you. So you're having to front up obviously the full 10% deposit. So there's that higher cost. There's obviously the stamp duty costs as well. So everything up front, it's like everything gets brought forward a lot quicker rather than buying off the plan. So, and obviously when you buy an established home, there's a lot more buyers out there wanting that same property as well.
Yes.
Probably buying off the plan, you're not typically going up and competing against, 20 other people. But buying an established property, you're typically buying either, whether it be a fixed price or if it's going to auction, there's going to be other buyers out there. It becomes quite a competitive environment that you have to work within. So you could end up paying more than what you potentially would want to. But they're all part of the pros and cons, I guess. So
it is risk to reward, I guess. So.
Exactly right. Yeah. All right. Should we go through maybe what's the best option, or which option suits which type of buyer first?
I think it's a mixed bag here because I've seen owner-occupiers buy off the plan and I've seen investors buy off the plan and vice versa with regards to established properties. I think instead of asking who is each option is best for, maybe it's best to understand what are you looking for? Like why would you buy an off the plan and why would you buy an established property?
Yeah.
In most cases, I've seen people want to buy off the plan because it's giving them that buffer. Mm-hmm. Also, buying off the plan can come with a reduced price. Yep. So you're taking the risk, but if a property is like, I've got one now where the client purchased an apartment in Sydney 3.5 years ago off the plan. Like, it was meant to finish like 2 years ago, but it's now coming to completion.
Yep.
And at the time, he purchased that apartment for $790,000. Comparable apartments that are going in the building that's being built now, it's going for $1.1 million.
Wow.
So it's a win for him because it's being built in a relatively secure location with, high demand on it.
Yeah.
But if he's like, circumstances have changed, or if he had lost his job, or any financial circumstances have changed, it could have impacted him a lot because he has already paid $79,000 deposit and he could lose that deposit. So it comes down to what's your objective, as always, like what are you trying to achieve and why would you take a higher risk? Is it the price? Is it the entry into the market off the plan? Like if you're saving $5,000 a month, in a year you'll have the funds required. So I
guess if you've got a lot more certainty in your mind around that your circumstances aren't really going to change, you feel secure in your job and everything else is ticking along nicely. Well, and if you've got the ability to have another 18, 24 months worth of savings to go towards it.
Yeah, exactly.
And then, if you're doing your homework really well and you're buying in a very good area or an upcoming area that you've done lots of research around, well, yeah, you can definitely
100%
nicely. So
and there's something for everyone. If you've got your cash ready, your finance ready, by all means go buy an established property and start getting gains from day one. But also, I'm not saying it's a bad option. It's just riskier, and you just got to be mindful about what risk implications that come with it. So do your homework or ask the questions and do a bit of research on the developer, on where it's being built, on the prices before you actually jump into it. And you can't control everything. You just got to take some risks sometimes, but yeah.
Yeah, and it's, with a lot of the off the plan, especially in the apartment side of things, do reach out to a broker with regards to where the development actually is, because some lenders I know have got like development registers where they want to make sure they don't have too much concentration with one particular development. So they may limit the number of properties they will lend to within that particular development, or even have a lower loan to value ratio as well. So very important. Don't just assume that every lender is going to lend to it. And obviously with a lot of apartments, we hear about from time to time, and the one bedroom apartments, some banks just steer away from it.
Yeah, the size matters when it comes to apartments.
You really got to make sure it's at least 50 square metres or above, excluding the balcony.
But having said that, there's options.
Yeah,
so that's
right.
why it's important to do your research and speak to a mortgage broker.
Yep, well and truly.
Yeah, I think this covers pretty much most of the pros and cons of buying off the market.
Yep.
As always, I think we need to, be just mindful about, like we said, speak to someone, get a pre-approval ready, work around what sort of funds you'll require by settlement, and just do your risk assessment and speak with someone that can help you with that risk assessment. Other than that, I don't know if I missed anything, Carlo, before we wrap up.
You've pretty much covered it all. And I think it's like, and we bang on about this all the time in all of our podcasts. It's about just getting the right type of advice from professionals who've seen this, done this. We've seen these type of deals all the time over the years. So we've seen the upsides and we've seen plenty of the downsides as well. So it's just making sure that you minimise all the risks that you possibly can. And if it works, fantastic.
That's it.
We're not saying don't buy off the plan, because it can work well and truly.
That's it. Just do your homework.
Yep.
Perfect. Thanks again for listening or watching. As always, feel free to send through any questions. Appreciate if you can leave us a 5-star review and subscribe to the podcast. Otherwise, we will see you soon with the next episode. Thank you very much.
Take care, everyone. Bye-bye.
Cheers. Bye.
Disclaimer. The information contained in this podcast is general in nature and does not take into account your personal circumstances.